Hello and welcome to UCIBL Applied Innovations VC Speaker Series. This is our weekly webinar featuring conversations with VCs and investors. Our goal for this series of events is to continue to connect the Southern California innovation ecosystem with the experts and the resources that will help the entrepreneurs and founders navigate this current crisis and then thrive in the recovery. For today's webinar, we're honored to have with us Jeff Bocan from Okapi Venture Capital. Not only is Jeff going to tell us about his firm, strategy, and portfolio companies, he's also prepared some slides to share information about the seed market evolution and the implications for the venture industry post-COVID-19. Before we get started, a few logistical details. As you'll notice on the Zoom webinar, all participants are muted. So if you have a question, please type it in the Q&A box, not the chat box, because we'll be monitoring the Q&A. I'll ask those questions throughout our discussion, or we'll do it right at the end. And this presentation is also being recorded, and it will be available later on the UCIBL Applied Innovation website. Keep an eye on your emails and social media for information about our next VC Speakers webinar. Should be announced shortly. So a little bit more about Jeff. Jeff's a partner at Okapi Venture Capital. He's an 18-year veteran of the venture capital industry, and he's also been an executive in the technology industry. At Okapi, he serves as the deal lead for several portfolio companies, including White Fox Defense Technologies, TrackStreet, CloudKeys, Nimble for Good, CLI Studios, Dacity, and Trellis Research. We'll get into Jeff's full background in a few minutes, but I will add that he also has an undergraduate degree from the University of Notre Dame, since I know that's important to those guys, and his MBA from the University of Virginia. So with that, let's kind of get things going. And Jeff, why don't you tell us a little bit more about your background and kind of what led you to this role that you have now?
Sure. Thanks, Luis. Thanks for having me. And thanks to the good folks at Kenobi Martins for hosting. We used Kenobi a lot when I was at Mofia, which I'll touch on later. But shout out to Steve Natopsky, Sheila Swaroop, and Linda Liu in particular. Yeah, so I got into venture about 20 years ago, and it was kind of by mistake, actually. I was wanting to, I previously had been at Honest Tea, which is an organic, freshly brewed iced tea. A lot of you maybe have had it at some point, or maybe you've had the Honest Kids juice boxes for your kids. I was one of the first employees at Honest Tea and helped, I joined that company early on when I was in business school, and then stayed with them for a little bit after business school. But I had a chance to move to London, England, mainly following my wife and her job. She's a lawyer. She had a great job opportunity to work at a law firm over there. Honest Tea at that time was missing payroll from time to time, and it was a struggling company that had no venture funding, no proper funding, and it was kind of an easy decision to move to London and follow her. She had a much better job. But once I got out there, I wanted to work at a startup. So I was networking around, and in that process, I got talking to a venture capitalist who I'm really being interviewed for one of their portfolio companies that I wanted to work with. And the firm is called Saffron Hill Ventures. And that interview process with the partner turned into him saying, look, rather than you work for the portfolio company, how about you work for us? And I'd said, look, I don't know anything about venture capital, but I'll work my butt off if you hire me. It sounds great. And in fact, I didn't know anything, but I'd never done it before. So that got me started in the end of 2001. And then I've been doing that more or less since, as you mentioned, 18 years. And I had a 3-year stint helping run one of my portfolio companies that we could touch on later.
Okay, so you've been both kind of on the operating side of things, as you mentioned, and also as an investor. So why don't you kind of compare and contrast those a little bit? Maybe what's more fun about being on the operating side than being a VC?
Yeah, so the operating side is kind of where I had mentioned when I was at Honest Tea, it's kind of where I started. I had this kind of entrepreneurial spirit. That's where I wanted to be. That was more interesting to me. And, I think both are great. What I really find more fun, I guess, about the operational side is kind of a couple of things. One, then the primary one is just the people. You just develop such deeper relationships within a company, and especially when you're leading teams, you're hiring folks and you're kind of sharing the daily, wins and agonies of a startup. But the relationships that you build along the way are, just unmatched. And the process of, I'm very competitive. I I like winning and building,
Right.
building and growing. And it's great celebrating those even small wins that may happen throughout the course of a day with folks on your team. That's one of the really big things that I miss about being on the operating side. And second, it's can be really great to just take a deep dive and become an expert in one particular thing that you're really focused on. And also things happen faster within in an operating role. Company has, weekly goals, monthly goals, quarterly goals, whatever it may be. The venture capital business is super long-term. I mean, we invest in companies and we can be holding them for 5 to 10, 12 years. So it's really hard to know. Sometimes, you feel like you're doing well. It's like a slow motion baseball game, on the venture side of things. And it takes forever for things to move along. Whereas in a company, there just seems to be this overall faster pace, which, I find a lot more enjoyable. So I definitely like that. I mean, there are definitely the downsides. I mean, it can be a real grind, and a lot of the problems you need to deal with, you're the one solving them, as opposed to being a venture capitalist who, you're kind of more like a coach in a game on the sidelines. You're not actually in the game fighting the battles. You're literally sitting on the sidelines and, doing what you can to get involved and influence what's happening, but you're not in there getting the bumps and bruises daily. And so, yeah, I enjoy both a lot.
Yeah.
To be honest, I think I'm really glad I had the chance to have a deeper operating role. It made me a better investor. I mean, the investor that I am today, I had 13 years of venture before having a really intense operating role, and I'm a much better investor now, I think. So, judging myself, there's a lot more. I'm asking better questions when we're evaluating deals, and I think I'm able to help the portfolio companies that I am working with better now, having 3 years of very intense experience on the
Okay.
operating side.
So, a lot of us, actually, I got to know you, and a lot of us got to know you when you came out here with Mofi. So why don't you tell us a little bit about that, how you ended up at Mofi, what you did at Mofi, and kind of how that played out here in Orange County?
Sure. So, I've done my venture capital career. I've done it in a few different markets. I was in London, England for 5 years. I opened an office for that London firm I moved to a different firm at that point called Berengia, opened an office for Berengia in Santa Monica for about 4 or 5 years. And Berengia had raised a fund focused on investing in the Midwest. This is right around the time of the recession. So I moved back to help run that fund in 2009 to Ann Arbor, Michigan. And I was focused on companies that were based in the Midwest. And in 2010, I came upon Mofi, which started in Kalamazoo, Michigan, of all places. And it started to grow really rapidly. Mofi's a consumer electronics business. Their most famous product was the Mofi Juice Pack, which is a protective case for your phone with a battery built inside it. And Mofi started growing really rapidly, and it became clear that Mofi could not scale a global consumer electronics company from Kalamazoo, Michigan. We just could not get the talent there, the right sort of, the right talent and the quantity of talent that we needed to fulfill our promise. So we actually very deliberately opened up an office in Orange County. We considered Southern California. We looked at San Diego, Orange County, and LA. We chose Orange County because we thought we could pull from both at the LA and San Diego markets, as well as the pretty robust Orange County market. There's a lot of relevant talent for consumer electronics here. So we set up and it was much cheaper, and the lifestyle was better, cost of living was better. So we set up an office here. And the Mofi headquarters kind of moved to Orange County eventually. And then in 2013, once the company got to about 100 million in revenue, at that point, the two founders had asked me to come on board, and I was getting more and more involved as a board member. And they said, "Look, will you just come on board to help us take the business to the next level?" So it was a chance for me to, one, get out of Michigan. I'm not from Michigan originally. I'm actually from Southern California, the Inland Empire, the mighty Rancho Cucamonga. So it was a chance to get back here. I have family here. California is a lot better than Michigan, I think, or at least for me. And so that brought me here to Orange County. And then Mofi continued to grow, and we had quite a few employees here at one point.
Yeah, no, that's great. Actually, I didn't know you were from Rancho Cucamonga. I'm from Fontana, so we share those Inland Empire roots.
Nice.
There. I hear this question a lot, and I'm sure you're asked a lot, but I think I want to throw it out there for our attendees. So, how deliberate was or how intentional was your career path to get you into VC many years ago? And what advice do you give to people starting their career that want to get into it?
Okay, sorry for the delay. My internet might have been slow. I think I heard all that question. My career path wasn't, I think I mentioned earlier, it was I got into venture capital a little bit by accident. So it wasn't super deliberate to get into venture capital. I was very deliberate about working at a startup, and I happened to get into this universe. But I think in terms of advice for others, and I get asked this question a lot, it's a hard one because the venture firms are really small. I mean, you'll see later, but we have a slide, there's 3 people at my firm. A lot of firms are pretty small, so there's not a lot of job opportunities that come about at any one given firm. So it really comes down to timing and luck, but also I think the key is relationships, and it's not so much how well you know somebody, but can they get the chance to see you work and operate. And I've just seen this a lot at a lot of other venture firms, and even when firms are looking to hire, the way that they go about hiring is they're usually asking who often it's kind of within the portfolio companies. Do you have some rock stars in your portfolio companies that you think would make great VCs? And if you were to go down the list of a lot of the venture firms, whether it's Bay Area or down here, most people have had startup experience. Mm-hmm. They were a product manager, they ran engineering, maybe they came from a product marketing role. It could even be a UX, UI design person, but that sort of skill set and of not only working at a company where you're experiencing the scale or the scaling process of growing really quickly from a handful of people to a lot, and scaling a product from a handful of users to millions. Those sorts of experience are what VCs are looking for. And that's the first place they're looking for talent. And again, they are really small firms, and they want to get a sense of how people work together. So there'll be a lot of referencing that they'll do. How does this person handle stress in a crisis, and how do they make decisions, and are they really collaborative, and how's their communication? And it's those sorts of softer skills that don't show up on a resume, but they're ones that you that are witnessed through real world experience, and that are validated through real world experience. That's what a lot of VCs rely upon when they're making hiring decisions.
Yeah.
So that's what I would say.
No, that's well said. Great advice. I tell people as well that, similar to what you did, do what you do very well, and build your connections, and more or less kind of be open and be open to those opportunities, kind of not necessarily go after them, but be open to them and be aware of them. And that will, that can help get you to that point. Okay, we're going to move on to our other part of our thing here, talking a little bit more about Okapi here in a second. But right here, I wanted to take just a short break to give a special thanks to our sponsors for the VC Speaker Series, Martins. So many of you know that Kenobi is consistently ranked among the top intellectual property firms in the nation and worldwide. And they have close to 275 lawyers and scientists nationwide, and dedicate its practice to all aspects of intellectual property and technology law, including litigation. So their headquarters here in Orange County. It's a great opportunity for us and here in Orange County to have such a great firm and have it headquartered here. And you can learn more about them at www.kenobi.com. So with that, Jeff, let's go ahead and kind of launch into Okapi a little bit more. And so you've also spent some time thinking about how the seed market has evolved and the implications for all of this. So why don't we start off with you telling us a little bit more about your firm itself, kind of who's there and what your strategy is.
Sure. So you heard a little bit of my bio, so I won't go into that further, but my partners, we all have extensive VC related experience and operating experience. Mark Averett was in an operating role both at Sun Microsystems and at Intel for quite a while before starting Okapi in 2005. And at Intel, he was managing the software strategy group and doing a lot of investments into, Intel doesn't make a lot of software, and they're mainly a hardware and chips business, but they were making a lot of strategic investments in the software space to build markets that could help grow the market for their chips. And Mark was doing a lot of that for quite a while, which created the opportunity, kind of got him in the position to launch Okapi. And I can get into more of that. Luis, I know you were right there at the start, so
Right.
you know it very well. And then Mark has been running Okapi since 2005, so 14 now 15 years of venture experience from there. And then John Waller, my partner, he's in Pasadena, which is great because he can keep me off the 405 as much as possible. So he covers LA a lot for us, and that gives me more time to be in San Diego and here in Orange County. I do get up to LA and elsewhere, and you'll see a map in a bit of where we invest. But John's based up there. He is more of the operator amongst all of us. He has the most operating experience. His first startup was one of the first internet advertising businesses called 24/7 Media. It kind of was a competitor of DoubleClick, and it went public in 1998. Unfortunately for John, it was a great time to go public, and he was CEO and founder, and luckily sold out before everything melted down. And that gave him a nice pile of cash to be a very prolific angel investor. And then he continued to start more companies along the way, including resume.com, which he sold to Adecco, which is one of the largest staffing companies in the world. And he was at Idea Lab up in Pasadena for a while as well.
Okay.
He joined when I joined. So we have, the team has some solid experience both on the investing side and operating side.
All right. Let's jump into your strategy here a little bit.
Sure. So we are a seed stage focused firm. We'll get into this a little bit. The definition of seed stage has kind of grown over the years, especially in the last 10 years. But really what that means, it's the first institutional round of money that a startup is raising. So it could be pre-seed, seed, or post-seed, there's different terminologies for it, but it's usually kind of that first round of proper capital that they're raising. We're very much focused on software-driven businesses. We don't focus on any one sector in particular, but we love cybersecurity and things in the e-commerce space, as well as fintech and things in the cyber defense and aerospace technologies. But we're mostly focused on enterprise applications where the end customer is a business. We will do some consumer investments, but we're much more selective there. But we absolutely will make those investments. But another piece of our strategy is that we're really focused on Southern California. And there's a next slide on it, but all 18 of our most recent investments are here in SoCal, and we have a very hands-on approach, more so than a lot of the VCs that we see in the market. We have a board seat. We usually lead most every deal that we do. We have a board seat, or at least an observer seat, with every investment that we make. And we do really put our shoulder behind, we try to leverage the operating experience that I mentioned of myself and my partners that we have in the past to really help the companies go from 5 to 15 people, 15 to 45, and just get through some of the, speed bumps along the way that companies experience. And it can be for really mundane things around hiring and scaling up your interview process. The CEO may not be able to interview every single person at some point in the business. And how do you start to scale up an operation? Not to mention scaling up your sales teams and engineering departments or whatever else it may be. So we are very actively involved in the first 3 years or so of the companies, and then we start to kind of fade in the background, and then we move on to the next ones. And then I think, go ahead.
Oh, I was going to ask you about the kind of the enterprise focus. Mm-hmm. So I'm curious as to, is that a result of what your experiences are, kind of more on the enterprise software side? Is it a reflection of the types of deals that you're seeing, or kind of what has led you to that? Because I actually believe that enterprise software is really one of the kind of inherent strengths here, certainly in our very local area. A lot of strong enterprise software DNA amongst the founders and the software engineers out there.
Yeah, I think you're spot on. What we really like about it, and it's kind of the evolution of enterprise software, is that it's getting more verticalized. And so you need to know the customer better. It's not just a matter of having an email solution that works for all kinds of different companies. You're finding very specific products for whether it's a fintech vertical or somewhere in insurance or even in the real estate market. And in Southern California, and this is kind of getting to your point, Louise, and I'm agreeing with you, but we have the real benefit in Southern California of the diversity of not only the people that are here in Southern California, but of our economy. There are a lot of different industries here, and businesses you really can do better if you're where your customers are. And there's so many types of businesses here, and we're finding a lot of great vertical SaaS opportunities emerging from Southern California. So we like that. Another reason why we like enterprise is that the barriers to entry are higher. I mean, the consumer space, it is so easy to launch an app or a consumer product, and they can absolutely take off, but it's really hard to maintain that position over time. So we like that. There's more of a reason to get acquired, I guess, if you're building something of value and that's difficult to build, and you're building a customer base that's hard to replicate, as opposed to just throwing. We have a small fund, so we can't afford to just put 20 million behind a company that's going to do a huge marketing campaign. We hope it makes a great, really sticks with consumers, and try to maintain that. So that just doesn't work for our model. And we feel like capital efficiency is really important. We'll get into that later. Especially, it's gonna be really much more important in the years to come post COVID. But we think capital efficiency matters, and enterprise SaaS businesses have the opportunity to be very efficient. And then the last piece, the founders that we typically like to back are, it's not the prototypical 22-year-old in a dorm room in Palo Alto. We're looking at, it's often a 35-year-old who's worked in an industry for 12 years and has gained a huge amount of domain experience in that industry, and has really identified some important pain points, and not only is very familiar with the problem and what that solution needs to look like, but also how that solution gets integrated into the rest of the tech stack that within that industry, and understanding how those sorts of companies make buying decisions, which channel partners you need to have to reach the customer. But we're backing an entrepreneur that it may be a first-time entrepreneur, but they have this deep industry experience where they have we think an unfair advantage and a real running start in launching their business.
Right. No, that's a great strategy. One of our attendees just asked, and I think it does fit on this slide very well. What's your typical deal size? Kind of maybe what's your check size and what's the deal size?
Thank you. I left that out. Sorry. Yes, our typical investment is $500,000 to $1.5 million in terms of range. The last 3 deals we did were $1 million exactly on the first check. And I put on there the pre-money values and equity. I thought this might come up or be useful, but most of our investments are that first investment is made sub 10 million pre-money for the business. Of our 18 deals, I think 15 or 14 of the 18 were sub 10. A couple were like at 12, and then we had 2 outliers, but they were later stage deals, and which were a little off. I can explain those later, but there are great opportunities. We're super excited about both businesses. It was slightly off our normal model, but we were being opportunistic about some things that we could get into that normally we wouldn't get a chance to with our check size.
All priced rounds, or do you do safe and notes on the first money in occasionally?
We almost always do price rounds. I'm just trying to think through. There's one of the 18 that was a note. Actually, sorry, 2 of the 18 we had done were notes before they got converted. But we, really we're leading the rounds, and we want it to be a priced round. There can be it's a whole separate topic, but there can be a real overhang problem of just having these notes accumulate and not convert, and it just creates a lot of issues down the road. But we believe in just setting a price and moving on, having a clean cap table, and being really well positioned to bring on capital further down the road, which almost all of our companies need to do. They're all going to need to raise another round of capital.
All right. Well, speaking of those companies, why don't we take a look at your portfolio a little bit?
Yeah, and this is just from our Fund 3. We have Fund 1 and 2 actually. That one has a couple companies that are stragglers that haven't exited yet, and then Fund 2 has maybe 12 or so active companies. But this is the snapshot of our most recent deals. These were all deals done since late 2017. Again, we said we'd focus on Southern California, and that's what we did. All the companies are here. They are in this range. And some of them are, we're lucky. Some are doing quite well, in this current environment.
Yeah, you mentioned that. Why don't you tell us about one of the ones that's doing pretty well, and then tell us about a couple other interesting ones.
Sure. One that's doing really well, and it ends up being kind of a no-brainer. And for folks who may have been at the Octane event, the TIFF event last year, it was the company that won the little pitch event that they do, but it's CLI Studios, which is a distance learning class or platform, which is focused on performing arts. It's kind of like Peloton for performing arts in both within dance studios and in K through 12 schools. And obviously, just and since we're all doing distance learning of some sorts, or our kids are these days, CLI was very well positioned for this, and they are just growing tremendously. They added more studios in the month of March than they had in the prior 2 years, and they had already had over 1,000. So they're growing tremendously, and then they're adding thousands of schools a month as well. And so we're really excited about what they're doing. And it's great, kids can still be active and do this, get great teaching at home for something like performing arts, which is a little harder to do. It's easy to do math problems at home. Well, maybe my kids wouldn't agree, but providing the dance content is great. And we have some other businesses that are doing really well in the e-commerce space, Track Street and Dacity in particular. E-commerce is, with a lot of the retail stores closed, people are still buying stuff, obviously. And I think we're all, as consumers, experiencing this and buying more things online. And both Track Street and Dacity are really in the slipstream of these companies that are growing really, there's just a huge volume of e-commerce revenue.
Yeah.
I think at one point I heard a comment from Shopify, which is a big public company. And if you just look at their share price, what's happened since January, it's gone from like 300 to 750 or something like that in that time frame. Their CFO said it's like they're seeing Black Friday volumes every day.
Wow.
So it's just incredible what for online selling.
Sure.
They have hundreds of thousands of commerce partners on their platform, but a lot of companies that are doing higher volumes of e-commerce revenue, that also kind of magnifies the problems that come along with doing e-commerce. And if for people that are on this webinar that are in the e-commerce space are probably very familiar with things that could be, maybe if it's on the fulfillment side or analytics or managing your marketing spend and conversion. And there's a lot of, or just managing your channel partners, whether your retailers, your physical retailers, wholesalers, direct to consumers, you have other resellers online, and managing all that is a huge headache. So there are a lot of B2B SaaS companies that we like that are focused on solving some of those problems. And as these problems are growing for companies, they're looking for solutions. Right. And then lastly, I'll just mention Chroma Code, which is down in Carlsbad. They're it's kind of a marriage of data science and molecular testing. And they have a technology that is actually now being utilized for testing COVID, which was just released a couple of weeks ago. But they're testing ultimately, I won't go into the details, it ends up being pretty technical, but the main takeaway is it creates a dramatic increase in the testing output and rapidly decrease the cost. So you've heard about these delays. I don't know if people have been involved with COVID testing or their family members or friends have, but it can take many days or a week to get your results back. And this compresses this radically to minutes. And then obviously brings a lot of the costs down in doing that. So we're excited that sort of technology not only hopefully will be a great investment, but have this real benefit of helping us all return back to more normal with improving availability of testing.
Okay, cool. One of the things that we've talked about with our other folks on this series is kind of what did they do and what advice did they give to their portfolio companies and how their portfolio companies responded on the crisis part of it. You've talked about some of the ones that are thriving. So what were the either general or specific instructions that you gave to the portfolio companies when this all hit?
Yeah, I mean, across the board, we started insisting this with everybody, like on May 4th, I believe. We sent an email out to all of the CEOs saying, we're going to line up a meeting and everyone has to completely redo their 2020 forecasts. Whatever assumptions you had. I mean, a lot of those budgets for 2020 were built in October, November, and obviously the world was very different. So every assumption needs to be looked at again. And we need to, entrepreneurs are naturally optimistic. I mean, you have to be kind of crazy to be a startup entrepreneur anyway, and super optimistic that things are going to work out. But, when there are these huge headwinds and this massive amount of uncertainty that we're all facing, you really need to step back and question everything. So we were walking through with our portfolio companies, literally line by line, dollar by dollar, head count by head count, like how is this what we really need going forward? Looking at both our revenue forecasts and maybe the timelines, if maybe we slow down how fast we were going to build product and launch them to market if we felt like the receptivity wasn't going to be there. And there's just a lot of things that we looked at, but it all came down to cash. in summary. I mean, there's a lot that we did, but cash is king. And it was all about extending the runway for all of our companies. Most all of our startups are losing money. So it was cutting the burn as much as we could for a lot of these businesses in the most sensible and strategic way. Obviously, you still want to keep the momentum and keep things moving forward, but we really need to buy as much time as possible. I've been doing this for about 20 years now, as we mentioned. So I went through the .com bubble burst, September 11th, and the financial crisis. And I've seen what happens, and there are some slides coming up here about kind of what happens after these events in the venture landscape. But in short, money for VC money starts to dry up. So for a lot of startups that are looking for capital, it's going to be much more scarce, and that's even for our own companies. So or all companies that are out there, but it's something that we need to be really cognizant of. So we need to buy ourselves as much time as possible to stretch those dollars and hopefully get on the other side of the market recovery, and ultimately maybe get the company down to a point where it could be self-sustaining, or where the burn rate is low enough where you can still maintain momentum, but do it in an affordable and sustainable way, or roughly sustainable way, if you could finance it through friends and family, angels, or just people who don't have the capacity to write really deep checks. But if your burn rate falls from 100,000 to 12,000, obviously you can have a lot more flexibility at that lower level. It can be painful, but in some cases that's maybe what businesses need to be prepared to do. And then of course we were helping companies with the PPP loan process, and a handful of our companies did receive some of those funds.
Good.
Some did not. I mean, it was an interesting decision to make. Some we felt like they actually have a pretty decent cash balance, and this money is intended for people that really need it. And so some companies that would have been able to get the money didn't take it. So those ended up being interesting board discussions.
Yeah, I can imagine.
There wasn't always agreement on those, but we did have a number of our companies get it, and a lot of them that did, it was really critical for them to buy them some extra time and do what that money intended, which was to not make some layoffs that we would have otherwise made. We kept some people on payrolls that wouldn't have stayed if we didn't get that money. So
that's great. That's
great.
great.
Those positions may still be at risk, but in the future, but hopefully they'll turn around.
Yeah, good. Let's go ahead and get into the other kind of part of what you prepared for us, which was the evolution of seed stage investing and kind of some of these others. So I think this is where you wanted to start off here, kind of showing a little bit about where we've been.
Sure, and I won't spend much time on some of these slides with the data, but really the point on this is that the number of seed stage funds raised since in 2011, and even you go back to 2008, has grown more than 5x. So there's been this explosion of seed funds on the market. There used to be a couple hundred seed funds out there, Okapi included. We've been around since 2005. Now there's nearly 1,000. And how these are defined as seed funds can be a little different. Some may be kind of traditional venture funds that have institutional capital behind them. Some may just be a family office that kind of spun out a little group, or maybe there's one or two dedicated people to doing deals, or maybe a 25-year-old that left Snapchat with $4 million and he's writing a bunch of $25,000 checks into companies and calling himself a venture fund. That's all kind of in this bucket, but there's been a huge amount. There's a real explosion of growth of the seed funds that we've seen, both on the really small end, sub 25 million, and kind of up to 100. And then unsurprisingly, go ahead.
No, I said I was just kind of leading you into this one. So what does that mean?
Yeah, so I mean, unsurprisingly, the seed round sizes have grown, and some of the entrepreneurs on the call may have experienced this themselves. But it used to be normal to do a $500,000 seed round for a long time, or $500,000 to $1 million. Now those seed rounds are growing. Sometimes you're even seeing them 5+, 10 million seed rounds. The average, you're seeing this blue line on the chart on the left, is the median is 2.2 million in 2019, and it was rising even up to 2.5 million Q1 of 2020. So with more money chasing deals, more money is going into deals. And then the other element that's happened here, and I'll touch on it later, the Series A funds have gone later, and companies are now forced to fund their businesses longer and later, or farther along before the seed rounds or seed firms will invest into their companies. So it used to be a 12 to 24 month window that a seed company would want to be funded with their seed money. Now that's gone to 36 months. So companies are having to raise some more capital at times, just to be able to bridge the gap and get to the sort of metrics and milestones that the Series A investors are expecting. And then, unsurprisingly, with more money chasing deals, pricing is going up. So you can see this on the chart on the right. From 2010, pre-money values are going for 3 million. It's heading up towards 10 for some of these rounds. But you can see it starting to fall back here from that Q1 data. I think you're going to start seeing that really move pretty dramatically as some more quarters unfold here in 2020. In the public markets, obviously, there was a big correction in mid-March, and it's been kind of climbing steadily back, somewhat surprisingly, over the last month. But there hasn't been that kind of recovery in the venture market. The price, I think a lot of the VCs are still feeling, as we get to subsequent slides, that there are a lot of headwinds here for startups, and they're going to need more money, and they need to last longer, and their valuations, the value that the entrepreneurs believe they've created at this point maybe isn't there, because the company, the market has changed in terms of the exit horizons and reaching the milestones going forward. It's going to take longer to get there.
Right, and that's led to some interesting trends. We're going to get to that in a second, but I just wanted to address, we're definitely getting a number of questions that are coming through in the Q&A box, so I just want to let everybody know I'm seeing them. I've got them in there. We're gonna take some time at the end to answer some of these other questions as well. All right, so let's get into what this has meant for the seed stage trends.
Yeah, at a high level,
5 to 8 years.
Yeah, so with this kind of explosion of the seed market, you have, a lot of the investors have ended, kind of having this sort of profile where they have taken kind of a spray and pray approach, where they write a lot of small checks into a lot of different companies and kind of throw a bunch of up on the wall and see what sticks, and then they try to get whatever money they can into those deals that look like they're going to work and cut their losses. That can be a fine strategy in principle. In practice, it's much harder to implement. Once the companies that have traction, usually there's a lot of competition to get into the deals. And if on this next bullet, if you're kind of passive and you're not really adding value to the company, the entrepreneurs are usually not going to fight too hard for you to get the allocation that you want into those deals when they are raising subsequent rounds of capital. Another thing that's happening is a lot of these funds, and it's some first-time funds that haven't been through a recession before, they don't have adequate reserves to support their companies. So they wrote a check perhaps for $500,000. And then they maybe reserved $500,000 to support the business, and that's it. And unfortunately, given what you saw in the prior charts of just what I referred to of the length of time that it's taking for companies to get to the A round, a lot of companies, and people on the call may have done this, they had to raise a seed 2 round or a seed extension round, or having multiple seed rounds happen.
Sure.
Because the company can't hit those Series A milestones, whether it's a certain ARR threshold of revenue or a certain kind of traction or acceleration of their growth. So the companies end up, what's happened, a lot of venture firms are kind of shot. They've kind of shot all their ammo at this point, and they don't have any capital to support their businesses. I know a handful of VCs that they're out of money to support their businesses from here. And what happens in a time of crisis, one, you can't support your businesses, and now your companies are really scrambling for capital. And if insiders aren't there to support the companies and help lead the rounds, it could lead to down rounds. There's this term, kind of terrible term, but it happens, called cram down rounds, where investors who don't follow their capital get kind of extra diluted. And for a lot of those seed funds that have raised or have been up and running, their return, it's going to reflect in their returns, which are going to end up being really poor. As they come down and haven't been able to defend their companies, they're going to get washed out. Right.
So you've clearly thought a lot about this. That's why I'm kind of advancing here. We know what got us here through 2019, but then everything changed. So what are some of the implications that you and your firm and your guys foresee here kind of going forward?
Yeah. So the main takeaway is, less money is going to be raised in the venture ecosystem, for the next at least 1 to 2 years and probably beyond that. You can see on this chart what happened post 2008. Venture funding fell 60% in that 1 year, and then slowly climbed up. 5 more years, 6 more years later, it got back to where it was. I don't see any reason why that's not going to happen again. And this is a function not of venture capitalists, but it's where our money comes from. Our money comes from university endowments, public pension funds, nonprofit endowments, that are now having to tap those endowments to fund their operations. And so they're not investing in illiquid vehicles like venture capital. Our funds can be tied up for like 10 years or more, or their public equity portfolios. And this is kind of a longer thing to explain, but this whole denominator effect, I mean, they have a lot of capital invested in the public markets. And if the public markets drop by 20%, now they're going to look over allocated to venture or other categories. So they're not going to be doing new investments in that space while their public equity portfolios rebound. So there's just going to be less VC money available to be deployed into startups for the next 2 to 5 years. Hopefully it's not that long, but that is coming.
Right. One of the things that we've certainly noticed, though, there seems to be a lot of M&A activity. I mean, there's definitely been an uptick in some large companies, though, making some acquisitions here. I read Microsoft has done 3-4 deals here in the last month already. So that's another kind of consequence of what's happening now. But delay in M&A activity, maybe some M&A activity really quick when valuations are so low. But I think going out 2 or 3 years, particularly on the IPO market, is going to be really challenging.
Yeah, I won't name the endowment, but they had a lot of exposure and they were really happy about it 6 months ago to Airbnb, and they were counting on a huge payola by the end of the year, and that's not going to happen now.
Yeah.
And that's really changed their investment strategy, particularly for venture going forward. And so, yeah, some of that's happening.
Okay.
So, what this means, I'll go through this quickly. I mean, this is implications for venture capital firms, but for entrepreneurs, you often need to think about if you are raising from VCs, you kind of want to think about your audience. But, for VCs, there are going to be fewer competitors. There are going to be less of those 1,000 seed funds that are out there now. There's going to be a huge shakeout, and a lot of those are going to disappear. And Warren Buffett had a quote, it's only when the tide goes out that you see who's swimming naked. And I think you're going to see a lot of naked swimmers and people are kind of go away. That
Not on this podcast.
No, that translates into better selection for VCs ultimately. And pricing is going to come down as a result. And then we've touched on it earlier, there are going to be a lot of underfunded existing companies, maybe some of these that, haven't been able to be supported by their existing investors that are a little further along than a typical startup. At more attractive pricing. So it's, high quality deal at a low price is going to be available now, where, that deal wasn't really available for a VC a couple of years ago. And then this chart below just shows, people can spend more time on it later, but, in the 2 years after both September 11th and the financial crisis, VC returns went up very considerably.
Right. And someone asked us in the chat and I responded. So just to let everyone know that we are going to have these slides posted as well. So you can dig into them a little bit more afterwards. So you talked about what it means for VC. So what is it going to mean for the startups themselves though?
Yeah. So it's bad news and good news. Starting with the bad news and kind of work our way to more positive news as we go. Obviously we touched on this, but there's just going to be a lot less capital available. And what's going to happen, unfortunately, is that traditional venture capital funding may not be an option for a lot of startups. So they're going to have to figure out another way to fulfill their dream and realize their vision. So they're going to have to bootstrap longer, demand effectively more sweat equity from founders and new people coming on, or people who are doing deferred compensation or reduced salary plus more equity, hitting up the angel market more than they might otherwise. And the F and F is friends and family. I didn't add the next F of fools, which usually comes with that, but friends and family, longer than normal, but which are smaller checks. But you're gonna have to stretch those dollars, which is on this next point, more than ever. So you just need to be really judicious with every single dollar you're spending to ensure that it is driving value for and progress for your business. Is this leading to the product getting done? Is this leading to a sale? So things like, some office space or some of the amenities that you may had, or some of the consultants that you might have been spending on, design consultants, or, some of these things are legal. It can just be a huge area of cost. I know Kenobi Martins is sponsoring this, so they'll probably hate this part, but, IP can be an area people spend on a lot early on. That is, the value can take a long time to be realized for that, if ever. And, that is an area that is a hard one to, those dollars you really got to question when you're spending, and be careful with that money. I guess moving as we go a little bit more positive, and was the Southern California ecosystem has been growing over the years. I think we've all experienced it who are on the call. And we think that's going to just continue to accelerate actually post-COVID. I mean, we're seeing a number. I just got off a call with a bunch of VCs from San Diego. And some of them were people who were transplants from the East Coast or the Midwest that were they said, look, with the economy changing and if it's going to be bad for a while, it might as well be somewhere where it's nice. And they've moved out to San Diego. And we're seeing that here in Orange County as well. And especially having that talent come from the Bay Area. The cost of living up there is so high. And the standard of living isn't as great. If you're if you're in a work from home situation, or if you're not working, staying in a place that's super expensive, maybe not make a lot of sense. People are coming down here. So we're having this great influx of new talent. And sometimes it's the capital. Some of the VCs, like I mentioned, the ones that were just on this call in San Diego are coming as well. And what this means for some of the startups is, hopefully there's a more available, great quality workers that are out there that haven't been here before, or at least in a higher quantity. And there is this downward pressure on salaries. You're not having to pay, to really stretch to get some of these engineers that maybe you had to fight for earlier. There's just going to be greater flexibility with the sort of unemployment rate that we're seeing now. Not only that, we're going to see, I think there'll be more startups to come about. I'm sure some of the people on the call aren't maybe the founders themselves, but are people that want to work at a startup. There are going to be more startups starting now than ever. A lot of startups come out of these sorts of downturns, and with people that are laid off and have time that, more free time, quote unquote free time, or it's recent college grads that, we have all these, I feel terrible for the class of 2020 that are kind of graduating into this job market, which is horrible. And some of these, college students are going to be focused on, or, college grads are going to be looking at starting companies, or at least joining companies, maybe with an experienced founder, but you can get someone that's coming out of school, that's hungry and has a huge amount of energy and is ready to work, which I think this is a positive for people. And then this last point, obviously the pandemic is driving a huge amount of innovation, and there's this demand for new solutions. And you see the quote in the box on the side from Satya Nadella, the CEO of Microsoft, where they're saying they've seen 2 years of digital transformation in 2 months. And I think we're all experiencing it in our lives. I mean, what we're doing right now is even a byproduct of it. I mean, people weren't really wanting to do these sorts of events, but now we kind of have to, because it's the only way to do these things. And people are looking for solutions and better ways to do a lot of things. And what we're seeing right now is that bigger companies are more willing now than ever to work with a new technology that's got a solution for their problems. And they're more willing to experiment. And so I think the sales cycles can get compressed. The sort of pilots and projects that you might have been pushed through earlier, and the delay of timing has accelerated. And one of our companies, it's a company called Cloud Keys, which does a contactless access control technology that lets you get into apartment buildings, retail environments, whatever, without having to kind of pull the door handle for areas that are secured. Doing a project with a large retail store that has a lot of PO boxes, for example, where they can let people into those PO boxes and even open the PO boxes without using their phone. And it's with a Fortune 50 company, and this went from being a 1-year test to like a 6-week pilot, and now we're rolling it out. I mean, they want a solution now, and they're kind of waiving things that they maybe wouldn't have done otherwise if it is a solution that is helping them solve a pandemic related challenge. So I think there's a lot of opportunity for startups where you can kind of get going faster than you might have otherwise. Yeah. So I mean, for sure, there's a lot of headwinds, and it's gonna be hard for people raising capital. But there are a huge amount of opportunities out there, and and I'm sure innovative people will. I'm excited. I mean, we as a fund are really excited for investing for the next 3 to 4 years. And we think it's gonna be a great time as an investor to back a lot of these new things that are emerging. And we're looking forward to working with a lot of these great companies here in Southern California in the years ahead.
No, that's well said. So why don't we jump into some of the questions here that folks have posed? We'll just maybe give it about 5 minutes of that. So someone asks, generally for Okapi, what type of traction do you guys like to see when you actually pull the trigger on a first-time investment?
Yes, it's a great question. We don't have a hard and fast rule on that. Some venture firms do, where they say, oh, we need to see 25,000 of MRR, or, a monthly recurring revenue before we invest. We don't have any hard metrics like that. What we're really looking for, we typically don't invest pre-product. We will on occasion. There are some exceptions if it's, on the 1 yard line and almost done, or if we have a huge amount of confidence and if it's someone we've worked with in the past and them building what they're trying to build. But usually there is a product and there's some validation of it that, A, customers use it. They don't even have to have paid for it, but we like to see that, that it works. So we try not to take a lot of technology risk. We want to invest in something that is working and that has some validation from the customer that it's genuinely solving a problem that they have. That it works kind of within the broader tech stack and ecosystem so it can be integrated easily into their workflow, that could easily be sold, that the price point makes sense and that the unit economics are such that the company can make money. This is a sustainable business here, selling at the price point that the customer is willing to pay and that you can deliver that product or service, at that, at a high margin, situation. So those are kind of the main areas that we look for. So it can be a company with no revenue and a bunch of kind of free trial customers. Usually I think the higher end is 1 or 2 million of ARR revenue that we'll invest into, but it's usually kind of 0 to 1 million.
Right. But range. I think the important point there is evidence. So you may not be looking for actual dollar values, but you're definitely going to have to key on some evidence. So,
yes, and what we're really focused on is scalability. I kind of left that out, but like at every single point, like, can this scale? Can this grow really rapidly? Can it be sold efficiently? Can it be onboarded really quickly with the customers? Can the technology platform scale? If we went from 5 customers to 500 to 5,000, is it not going to break the technical architecture? Those are the things that we'll be trying to assess early on. And there may not be a lot of customers to prove that, but the evidence, as you mentioned, a lot of the evidence is usually there pretty early to get a sense of whether it can scale.
Yeah. Interesting question that popped up because we've talked about it on a few others. Now that you can't meet someone face to face, you can't shake their hands. What do you think is going to be the near-term future for VCs to build trust with entrepreneurs?
Yeah, that is a great question. It's fun. I talk about it with some of my VC friends. I just had a call with one the other day, and they're of the mind where they're probably not going to invest without having a lot of the face to face. We're not of that mind. We'll get to know people, through this sort of means, and we will do some face to face, but with appropriate distancing. We did a interview for someone where we did it at a park, and we were in chairs like sitting 20 feet apart, and it's weird, but like you can still get to know somebody. So we're carrying on and doing that where we need to, and it's just going to be awkward and probably a little bit weird, and hopefully it gets somewhat more normal as we go, but we're continuing to do it. But getting to know people, at least for starters, through this means is what we kind of are stuck with.
Right, you're going to have to do that. So just kind of a little bit of a nuts and bolts question, but what do you see kind of on, salaries and equity grants right now? Both kind of what's the difference right now, kind of Southern California? Do you see Southern California, say, versus the Bay Area? And I think I'm going to add a little bit to this. Have you seen, or did the boards discuss changes to the salary versus equity stock option grants as a way to extend runways?
Yeah, great questions. High level, we generally see salaries about 25 to 30% less in Southern California than in the Bay Area for most positions, generally. And it's just much more competitive for talent up there. And a lot of venture-backed companies that are up there are pretty flush with cash. They've raised huge rounds, and so they're shelling out the dollars. We don't have that dynamic as much down here. It's not always the case. We haven't seen a lot of downward pressure yet on the pricing, but it's starting to happen for positions. I think you're just having some people now who got laid off or whatever, and they're going to just be, you're not having to pull them out of businesses. They're just available, and they may be not negotiating as hard for salary. On the equity piece, we haven't seen a lot of that yet in terms of that shifting at the moment as part of the hiring. I think I mentioned earlier that I think that is a lever that people need to utilize when they are cash poor. That they're going to have to offer more equity early on to get people to come on board. I think that's just going to have to happen. But I had a board call last night where it was a company that did have to make some layoffs, and we actually gave a lot of options across the board. Every single person in the company got some more options, and we gave even more for those who remain. And some people had taken pay cuts. We've been utilizing that as a balancing factor.
Right, right. Yeah, I've seen that as well. Kind of a little bit of a reset of the option pool happened a few weeks ago when some of the senior staff, and it's medium-sized-ish company, so they had to adjust salaries, so they kind of did a little bit of reset on the option pool. Maybe the last question here, and I'm sorry we're not going to be able to get to everyone, every question out there. So have you seen any changes to the term sheets here in the last month other than valuation?
Valuations for sure come down considerably. No, I think sometimes I haven't seen a lot of data points on it. There's a little, but where change is going to happen, it's going to be on the liquidation preference section. And there's something called a participating preferred that people can look up subsequently, or we can talk about it later. But that usually is kind of comes about in times of post-recession. I haven't seen any yet, but those usually do come about. Yeah. And also full ratchet anti-dilution language, and those can be really tough on the entrepreneurs that are raising the capital. People may have to look up some of these terms after. We probably don't have time to get into it all, but those are the areas that, like, on previous downturns, those were areas that I would see the biggest kind of more aggressive terms, I would say, from the investor side is right there.
But haven't started to see those yet.
No, but to be honest, I just haven't seen a huge amount of term sheets, and the ones that we've written we've not done any of that. Okay.
All right. So we're going to go ahead and wrap it up here. So Jeff, I definitely want to thank you for participating. This was really good. You shared some very unique insights. We've been doing this now for I think 7 weeks, and there's some very kind of fundamentally new things that we were able to discuss today. So we very much appreciate that. And I also want to thank our sponsor again, Kenobi Martins. So, Kenobi is a unique intersection of technical intelligence and legal acumen for a world powered by innovation. And I've certainly seen that in working with the folks at Kenobi. There's many PhDs, many scientists that went over and became IP lawyers. So you're going to get a lot of terrific assistance over at that area. And then finally, if you want to listen to this again, or you weren't able to catch all of it, the recording and the presentation slides will be available on Monday morning. And you can go to our website, innovation.uci.edu/weekly webinars, and you can find everything there. So I think with that, Jeff, once again, thank you for participating. We're bringing it in here right at the hour mark. And hope you have a good rest of the day in your backyard back there. No swimming naked or whatever you said you were being encouraged to do by.
I don't know. It is Friday. We'll have to see how that goes.
Okay. All right. Well, thanks everyone. Have a safe weekend. Be healthy out there, and stay tuned to your emails for our next one. So long.
All right. Thank you.